Nobody tells you about the threshold. They tell you to save more, spend less, open a Roth IRA, max out your 401k, start early, stay consistent. Time in the market beats timing the market. You've heard all of it. You could probably recite it in your sleep at this point. But there's a number that changes everything, and almost nobody talks about it directly. Not because it's secret, not because it's complicated, but because the finance world, for reasons we'll get into, has a strange incentive to keep you focused on the process and not the destination. The number is $250,000. Not $1 million, not $500,000, not some vague financial freedom figure that shifts every time you read a different article. 250. And once you understand what actually happens at that number, mathematically, psychologically, and in terms of how money behaves, your entire relationship with saving and investing changes permanently. This is not a motivation video. We're not here to tell you you can do it, champ. We're here to show you the math that most people never see until it's already working for them, or against them. Let's start with a man named David. David is 34 years old. He makes decent money, not spectacular money. He has a 401k he's been contributing to since he was 26, plus a brokerage account he opened during the pandemic because everyone else was doing it. He checks his portfolio maybe once a week, sometimes more when the market is doing something dramatic, which lately feels like always. On a Tuesday morning in March, David opens his investment app. He does some rough mental math. He has about $60,000 in his 401k, maybe $20,000 in his brokerage account. He's been contributing consistently for 8 years. 8 years of discipline, of choosing not to spend money he could have spent, of watching his friends buy boats and take business class flights to Cancun. And his portfolio, after 8 years, has made him roughly $11,000 in returns. $11,000 in 8 years. That feels like an insult. Here's the thing. David isn't doing anything wrong. His math isn't broken. His strategy isn't flawed. He's just in a part of the journey where compounding is, to use a technical term, barely doing anything. He's at the bottom of the curve. And the curve, this is the part nobody explains well enough, is not a straight line. It's not even a gentle slope that gets a little steeper. It's something closer to flat, 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 then suddenly vertical. And the inflection point, the place where flat becomes vertical, is somewhere around $250,000. To understand why, you need to understand what compounding actually is. Not the definition. You know the definition. You need to understand what it feels like in real time, because there's a massive gap between the concept and the lived experience. Imagine you have $10,000 invested. The market returns 7% this year, which is roughly the historical inflation-adjusted average for a broad U.S. index fund. 7% of $10,000 is $700. That's what the market just handed you for doing nothing. $700. Now imagine you have $100,000 invested. 7% is $7,000. A month's salary for a lot of people, from nothing, from just existing in the market. Now imagine $250,000. 7% is $17,500. In a single year. That's a used car, a kitchen renovation, a year of college tuition, generated passively while you did your job, watched Netflix, argued with people on the internet. But here's where it really gets strange. Because that $17,500 doesn't disappear. It stays in the market. And next year, you're not earning 7% on $250,000. You're earning 7% on $267,500. And the year after that, on $286,000, and on and on. The money starts making money that makes money. It sounds like a cliche because it is one, but the reason cliches exist is because they're true. And the reason this one doesn't land the way it should is because we're not wired to feel exponential growth. We feel a linear things. We feel a raise. We feel a bonus. We don't feel a curve accelerating underneath us until we're suddenly moving very, very fast. Here's the number that should stop you in your tracks. A 25-year-old who invests $250,000 today and never contributes another dime will have, at a 7% average annual return, approximately $3.7 million by age 65, without touching it, without adding to it, just by leaving it alone for 40 years. $3.7 million from $250,000. Now here's the uncomfortable part. Most people spend their entire working lives trying to save their way to that number, contributing every month, maximizing employer matches, doing everything right. And they get there eventually, maybe in their 50s or early 60s, just in time to start withdrawing it. But the people who get to 250 early, in their 30s or even their early 40s, they don't just hit the target, they blow past it, because they had more time on the curve. They sat in the vertical part of the graph for longer. This is why Warren Buffett, who was one of the greatest investors in human history, made 97% of his net worth after the age of 65. Not because he got smarter, not because he suddenly found better stocks, but because his compounding had enough time and enough mass to become something almost impossible to comprehend. He wasn't a genius who got rich. He was a patient man who got old while his money was in the market. $250,000 is the point where your money stops being savings and starts being an engine. But let's be honest about something, because this is where the uncomfortable math lives. Getting to 250 is genuinely hard. Not impossible, but hard. And the internet's relationship with this fact is, to put it charitably, complicated. There's an entire content ecosystem built around personal finance. Podcasts, YouTube channels, Instagram accounts, newsletters, books, courses, and an enormous percentage of that ecosystem is implicitly designed around the idea that saving is the primary variable. Save more, cut the latte, cook at home, drive a used car, hustle on weekends. Now, none of that advice is wrong, all of it helps, but it quietly obscures a more important truth. For most people, the gap between where they are and $250,000 is primarily an income problem, not a spending problem. You cannot frugal your way to $250,000 in any reasonable time frame on a $40,000 salary. The math simply does not cooperate. Let's say you're saving 15% of a $50,000 income. That's $7,500 a year going into investments. At 7% average annual returns, it takes you roughly 18 years to hit 250. 18 years. If you start at 25, you get there at 43, which means you still have 22 years of compounding ahead of you before the traditional retirement age. That's meaningful. That's a real result. But if you can increase your income or your savings rate significantly, the timeline compresses dramatically. Saving $20,000 a year instead of $7,500 gets you to $250 in 9 years instead of 18. Same investments, same returns, just more fuel going into the engine. This is why the most honest financial advice sounds less like cut your expenses and more like the gap to the inflection point is the most important number in your financial life and you should treat it like an emergency. Because once you're past it, the engine starts helping you. Before it, you're pushing alone. There's a psychological shift that happens at 250 that's harder to quantify but maybe more important than the math. Financial researchers call it the transition from accumulation anxiety to compound confidence. That's a clinical way of describing something very human. The moment when you stop being afraid that the market will take everything you have and start understanding that time is working for you. Before the inflection point, a 20% crash is terrifying. If you have $50,000 and the market drops 20%, you've lost $10,000. That's a car. That's months of savings erased in a week. After the inflection point, say you have $300,000, a 20% crash is still uncomfortable. You've lost $60,000 on paper. But here's what you also know if you understand where you are. You're still at $240,000. You're still on the curve. And if history is any guide, you'll recover. And when you do recover, you'll recover with $300,000 working for you again, not $50,000. The math of loss and recovery works differently at scale. At low portfolio values, a crash can set you back years of contributions. At higher values, the same percentage crash is painful but recoverable because your future returns are coming off a larger base. There's a darkly funny corollary to this. The people who most need to stay calm during a crash are early investors with small portfolios, are the ones statistically panic sell most often because the loss feels catastrophic relative to their contributions. Meanwhile, the wealthy investor with $3 million watches a 20% crash turned into a $600,000 paper loss, shrugs, goes to play golf, and waits. Not because they're braver, because they've been through enough cycles to understand that the curve rewards patience disproportionately. Staying invested through a crash at low portfolio values is hard. It requires discipline. Staying invested through a crash at high portfolio values is almost easy. The math has become your emotional support. Now let's talk about something the financial media almost never addresses directly, which is the relationship between this number and inequality. Because you can't discuss the inflection point honestly without going here. The reason 250,000 is transformative is the same reason the wealth gap compounds over time. The people who get to the inflection point early, whether through high income, inheritance, or luck and a combination of all three, get to spend the most time on the vertical part of the curve, and the returns from that part of the curve dwarf everything that came before. Consider this. The top 1% of American households own approximately 32% of all stocks and mutual fund assets. The bottom 50% own about 1%. This isn't just income inequality, it's compound growth inequality. The rich don't just earn more, their money earns more, grows faster, and compounds longer. The engine metaphor isn't poetic, it's structural. A household that reaches the inflection point at age 35 through some combination of income, inheritance, and frugality will generate passive returns over their lifetime that exceeds, often by multiples, the total lifetime savings of a household that reaches the same number at 55. Same number, different timeline, wildly different outcome. This is not a political statement, it's a mathematical one. The curve does not care about fairness, it cares about time and capital.
Here's where the story gets more interesting and a little more uncomfortable. Once you understand the inflection point, you start to see it everywhere. Not just in personal investment portfolios, but in how businesses scale, how cities grow, how careers accelerate. There's a version of this curve in almost every system that involves compounding returns, whether those returns are financial, social, or reputational. The startup that reaches product market fit, the content creator who hits 1 million subscribers, the athlete who breaks into the top 10 in their sport. Before the inflection point, effort produces modest results. After it, the same effort produces disproportionate results because you've built enough mass that the system starts working with you instead of against you. This is what some economists call increasing returns to scale, and it's why certain things in the world seem to accelerate mysteriously while others plateau. The acceleration isn't mysterious, it's structural. It's the curve. In personal finance, the implication is stark. There's a phase of your investing life that is primarily about discipline and sacrifice, saving when you don't want to, staying invested when the market is doing something alarming, contributing consistently even when the returns feel insulting. And then, if you survive that phase long enough with enough capital, there's a second phase, a phase that requires less discipline because the math starts to handle the motivation for you. A phase where a single good year in the market can match or exceed your annual contributions, where the passive income from dividends begins to feel like a second income, where you start to genuinely understand, viscerally and not just conceptually, what people mean when they say money makes money. Most personal finance content is written for the first phase, which makes sense, that's where most people are. But it creates a strange blind spot around the second phase, a silence around the moment of transition, and a general undercommunication of just how different the experience of investing becomes once critical mass is achieved. Let's talk about the specific mechanics of what happens to a portfolio in the years around 250, because the numbers are genuinely surprising if you've never mapped them out. Assume you've been a disciplined investor for a decade. You've built up a portfolio of around $150,000. You're contributing $12,000 a year. The market average is 7%. Here's what your next 10 years look like, roughly. Year 1, you earn about $10,500 in market returns, plus your $12,000 in contributions. Portfolio ends the year at around $172,000. Year 3, you're at around $205,000. Your annual market return is now roughly $14,000. Your contributions are starting to look modest compared to what the market is doing for you. Year 5, you cross $250,000. Your annual market return is around $17,000 to $18,000. You're now in the territory where, for the first time, the market's contribution to your portfolio is larger than your own annual contribution. Read that again. The market is putting in more than you are. Year 7, you're approaching $320,000. Annual returns are north of $22,000. Your contributions are now the minority voice in the conversation. Year 10, you're closing in on $400,000. Annual returns around $27,000 to $28,000, and the gap keeps widening. This is what the inflection point does. It's not that the returns become magical, it's that they surpass and then dwarf your own input. You go from being the primary engine of your portfolio's growth to being a supporting character in a story that the money is now telling itself. Most people feel the first version of this shift, the moment their annual returns exceed their contributions, as something close to disbelief. After years of doing the math and watching contributions dominate, the reversal feels almost wrong, like a glitch. It is not a glitch, it's the curve. There's a version of this story that should make everyone feel at least a little cheated. We are excellent as a culture at telling people to save. We have entire industries, entire regulatory frameworks, entire media ecosystems devoted to the message of save more, spend less. And these messages are not wrong, but they exist almost entirely in the vocabulary of discipline and sacrifice. Almost nobody teaches people the vocabulary of mass, of critical mass, of what happens when you stop being the engine and start riding one. The transition is real. It has a specific geometry, and it starts, for most conventional investors, in the neighborhood of $250,000. If that number were taught in schools the way the Pythagorean theorem is taught, here is a thing that exists, here is how it works, here is why it matters. The relationship between ordinary people and their investment accounts would be fundamentally different. Not because knowledge automatically produces wealth, but because understanding the destination changes how you navigate the journey. A sailor who knows there's a current at a certain latitude will plan differently than one who doesn't. Not necessarily better, but differently. And sometimes differently is everything. We should say something about risk, because this would be a dishonest conversation without it. The inflection point assumes a few things. It assumes the market continues to produce historical average returns over long periods. It assumes you stay invested through downturns and don't make catastrophic allocation mistakes. It assumes inflation doesn't permanently erode the real value of your returns in ways that 7% nominal gains don't offset. None of these assumptions are guaranteed. Markets have long stretches of low returns. Japan's stock market peaked in 1989 and didn't return to that level for decades. There are real scenarios where the historical average doesn't apply to your specific time horizon. The curve exists, but it requires time, stability, and reasonable returns to manifest the way the textbooks describe. There's also a more mundane risk, the risk of needing the money before the curve does its work. Emergency expenses, health crises, job loss, divorce. These are not abstract threats. They're statistical certainties distributed across a population, and each one has the potential to interrupt the compounding at exactly the moment it was beginning to accelerate. This is incidentally why the financial community's obsession with emergency funds and proper insurance isn't just conservative hand-wringing. The emergency fund protects the engine. It is not in competition with investing. It is what allows investing to continue uninterrupted through the events that reliably derail it. The 250 number is real. The curve is real, but it requires a protective structure around it to work the way the math suggests. Without that structure, you don't get a curve, you get a series of resets. So where does this leave you? If you're early in the journey, under 50,000, maybe under 100,000, the honest message is that you are in the hard part, the part where discipline is everything and the returns are, by design, unimpressive. This is not a sign that the strategy is broken. It is a sign that compounding requires mass before it produces velocity. The number to hold in your mind is not your current balance, it is the distance between your current balance and the inflection point. That gap is the most important financial metric you have. It is more important than your expense ratio, more important than whether you have a Roth or traditional IRA, frankly, more important than most of the optimization level decisions that dominate personal finance content. Get to 250. That is the mission. Everything else is implementation. If you're already past 250,000, if you're at 300, 400, 500,000, and watching your annual returns start to do something that feels almost embarrassing in its ease, then you're already on the vertical part of the curve. The discipline that got you here is still required, but the math has started pulling in the same direction. And if you're just starting and $250,000 sounds like a number that belongs to a different person living a different life, here is the thing worth holding on to. The curve exists regardless of where you begin. The inflection point exists regardless of income. It takes longer on a lower salary. It requires more sacrifice. The runway is longer, but the geometry doesn't change. Same curve, same inflection, same engine waiting on the other side. Here's the question that doesn't have a clean answer, and it's the one worth sitting with. If the math works the way we've described, if the curve is real, if the inflection point is real, and if the difference between getting there at 35 versus 55 is potentially millions of dollars, then what does it say about a society that structurally underpays its youngest workers, burdens its students with debt precisely during the years that matter most for compounding, and builds its consumer economy around ensuring that disposable income gets disposed of rather than invested? Is it possible that a system genuinely optimized for broad wealth accumulation would look very different from the one we have? Is the conventional financial advice we receive a sincere attempt to help people reach the inflection point, or is it, perhaps without anyone consciously designing it that way, a set of instructions optimized to keep people productive, employed, and spending, while the curve does its quiet, disproportionate work for the people who found it early enough? The math doesn't answer that question. The math just shows you the curve. What you do with it is up to you.